Welcome to Newly Invested, the podcast that's all about the real, sometimes raw journey of real estate investing. I'm your host, Judith Tait, bringing you conversations from the trenches of the investment landscape where we celebrate victories, learn from setbacks, and unlock the secrets to successful property investing. Whether you're a novice investor seeking tips and guidance or a seasoned pro eager to share your story, you've come to the right place. Let's get started and delve into the exciting world of real estate investing. Hello, everyone. Welcome back to another episode of Newly Invested. I'm your host, Judith Tait. Real estate investing, it's not just about real estate. It's about branding, it's about marketing, it's about building relationships and all the other tasks and responsibilities that come with it. So our guest today speaks well to all of this, and he's going to take us on his investing journey from teaching people how to grow their real estate business using a podcast to becoming an investor himself. So I'd like to introduce you to Trevor. Hi, Trevor.
Thank you. Super excited to be here and to chat with your audience.
Yes, this is great. So I'm just going to go through your short bio here. In 2017, Trevor Oldham founded Podcasting U to help alternative investment companies build brand awareness and generate more leads and clients through podcast guesting. So far, Podcasting U has worked with 400 plus companies and booked 6,500 plus interviews. Trevor is personally involved in NNN deals, multifamily, and self-storage development, and investing in mortgage notes, all while continually expanding his real estate portfolio. Welcome, Trevor.
Thank you.
Yeah, that sounds like you've got a lot packed into a nice short bio. I like bios that give a lot of information, but they're short, sweet, and to the point. So, okay, so tell us what are NNN deals?
Yep. So that's going to be a triple net lease deal. So it's
Okay.
typically a building where you're going out there and the tenant, I want to make sure I'm saying correctly. I believe the tenant pays the taxes, they pay the insurance, and they cover the maintenance on the building as well. So it's basically not so much me, but the person that I invest through. So they go out, they buy the building. So as an example, they own the building and the tenants, they typically work with your corporate, they call them your corporate grade A tenants. So
Okay.
it's like Dollar General, AutoZone, just big corporate brands. And they basically are leasing the space out to them. And then we get the monthly rent on the back end. So it's a very stable investment opportunity. Outside of that, like there's like a Walgreens, your pharmacies, just really any big ticket retailer. I mean, you could think of like Walmart and Target. Those are typically triple net lease opportunities where that company doesn't want to own the building, but they take care of everything and we just get that nice cash flow coming into it. Even
Hmm.
as small as the portfolio that I'm invested through, they also invest in a vet office, which is pretty cool. And
Oh,
it's crazy to me because you'd think like it looks like a mom and pop vet office, but it's owned like by like $1 billion corporation.
wow.
It's pretty crazy, but I really like it. It's really stable cash flow. I mean, we're talking 7 to 10% annually, and for in this investment deal, I get it paid out monthly, which is really nice. So I get the monthly distributions, and it's pretty safe for the most part. I mean, really, the big thing would be like if the tenant decides to move out, but a lot of times they work in the contract, like what would happen if that were to happen, they would have to pay 3 years worth of rent and different things like that. So it's relatively stable, but because of that, you're not going to make like, a 15 to 20% return on an investment. You just get a nice stable anywhere from 7 to 10% on it.
That sounds really lucrative. So, from what you're saying, it sounds like this is all in the States. Is that
Hmm.
correct?
Yep, correct.
Oh, okay. All right. Where specifically in the States do you invest?
Yeah, so I like to say our red states in the state in the US. So you're more a conservative state. So like I live in New York,
Yeah.
so I wouldn't invest in New York. I wouldn't invest in California. There's just they're not landlord friendly. So I look towards those landlord friendly states. So it's going to be the South. So like for these particular properties, they're in like Arkansas, they're in West Virginia, just places where they're going to be a little bit more landlord friendly and not so much, not that you don't want to be tenant friendly, but like in
Yeah.
New York, tenants can definitely take advantage of the opportunities that are out there for them. Where in the
Mhm.
red states, I find it just my preference, honestly, where like in New York, if someone doesn't pay their rent, it could take 6 to 12 months to kick them out. Where like if you're
Yeah.
investing Arkansas could take a month or 2 weeks to kick them out. It's just different rules on how they're rent. Not to say like on a triple net lease where I don't think like Dollar General would just stop paying the rent on it, but just for my
Yeah.
preference, I do like investing more in the red states. Again, I love living in New York, but I'm like I never want to invest here. I don't want to own any property here. I can see the problems it causes in like the local meetup groups. I'd rather just invest somewhere else where the rules are just a little bit easier for the landlords.
Yeah, there's been a lot of talk with investors here in Canada, and I'm in Ontario, about investing in the states and specifically the red states.
Hmm.
And the same type of issues, like here in Ontario, the landlord tenant laws are just they favor the tenants very highly, whereas other parts of Canada, like say more out west in Alberta or out east in like New Brunswick, they're more landlord friendly.
Mm.
So that's what people seem to be going for now. And we've had a lot of changes. Um, for one thing, our CMHC MLI Select program, there was a change in that program as well as the capital gains tax. So I'm starting to see a lot of people showing an interest in and kind of starting their investments or moving their investments to the States.
Yeah, no, I
Yeah.
could definitely see that.
Do you notice, have you noticed a lot of Canadians coming down to the US to invest, or have you worked with any?
Yeah, so we've definitely worked with a few Canadians in our business, but yeah, I definitely see them investing in the States, which is pretty interesting. It's actually not, I always think it for me, it's like interesting because I haven't looked at really Canada to invest in myself, just I just keep it in the US, but I definitely see some Canadians have been investing in the US. And like you mentioned, they're typically looking at like the markets that we're talking to. And really the biggest thing that I found, at least for me as a passive investor, where I'm not the one going out there and managing the property. I'm just basically vetting different people that are putting together the deals, and then I'll write them a check, and then they go out and purchase that property. I find that there's just more, just given the country size, there's just more sponsors and operators in the US than there is going to be in Canada. So there's just more opportunity to find different people that I want to work with. So I found
Yeah.
that's one of the bigger reasons I find people invest in the States, because I believe it was in 2012 is when there was some law passed, and I forget the name of it, but that's what allowed all these sponsors to go out there and start raising capital. And like really since 2012, it's just pretty much exploded. Where now I could take, I could go out, I could find a property, and I could raise all this capital. And because of that, there's a huge influx of people doing this. Not everyone's, good. That's why you have to vet the operator and the sponsor that's doing it. But I feel like there's just a ton of people out there. I mean, there's probably 3 to 5 thousand companies out there that are doing this model of going out there, finding the property, raising the capital, and then on their end, they might have a split. A lot of the times, the split might be usually it's about an 8% preferred return, so I have to get the 8% before the sponsor gets paid anything, and then after that, we might split it 70-30, and then maybe once we hit a 10% return, then we split it 60-40, and then 12% return, we go 50-50. So there's different things like that where you always have to look at the
Okay.
different operators and sponsors, see how they're structured. I think one time I came across an individual and it was like 20-80. I was like, well, that seems pretty heavily favored for the person putting together the deal. I only get
Yeah.
20% and they get 80%, yet I'm funding it. So you just look for little things like that. I noticed when talking to the
Uh,
sponsors. But yeah, there's just been a massive influx of them the last couple of years.
okay. Interesting. So, how did you get into real estate investing? Let's start with your podcasting you business. Tell us about that and how that
Yeah,
led you into real estate.
yeah, most certainly. So it was actually back in 2015, and I just wanted to go out there and start my own podcast. I was running a different company at the time, and back in 2015, podcasts they still like they're definitely not as popular as they were today. People are listening to them, but definitely not as much as of right now. But I thought
Mhm.
it'd, again, just be cool to start a podcast, and I ran that podcast for those 2 years, and I was doing everything. I was booking the guests, I was editing the show, writing the recap of the show, creating the social media clips for the show. So basically everything that goes into a podcast. Fast forward 2 years from that, I just started freelancing the skills that I had learned. I was still in college at the time, and I didn't really want to go out there and get like a regular, typical college job that would more often than not just be minimum wage. I'd rather just go work online. So I just started freelancing everything I had learned. Long story short, after about a year of doing my freelancing, and I was just finding clients through the platform Upwork, I probably had like 10 or 15 people
Oh.
that wanted to go out there and get booked on podcasts. And I would just go every single day. I would show up to the freelancing to Upwork and just search for people that wanted to get booked on podcasts. And we were
Hmm.
working with like, I should say I was working, I didn't have any employees at that time. I was working with every single niche that I could work with, whether they were in real estate, whether they were in business, whether they were a politician in the health space. And after about 2 or 3 years of doing that, I was like, I feel like I'm just spinning in circles because every time you take on a client in a new niche, it was like we had to go make new relationships with the podcast hosts, and that can just take a lot of time. And I was like, who do I like working with the most? What do I have the most interest in? And that obviously came back
Ah,
to real estate. I had gone out and got my real estate license as a realtor. Never did anything with it, but I
huh.
always had that interest in real estate. And that just opened up the box. 'Cause I mean, you're talking about real estate. I was like, oh, like I'm gonna niche down to real estate. But then within real estate itself, there's so many niches depending on what type of asset class that you're working with, whether it's say a multifamily, whether it's the triple net lease that I was talking about, then you have your self-storage and mobile home parks. I mean, there's so many different opportunities within real estate to invest. And I think one day I was just talking to my business coach and he was like, why don't you invest in real estate? I mean, you're working with all of these real estate clients. And I was like, honestly, I never thought about it. And I started
Huh.
doing some digging and I was like, I don't know if I necessarily want to deal with like tenants and that type of thing. I'm pretty busy as it is and just kept doing the due diligence. And then that's where I came across passive investing, where I was like, oh, I could write someone a check and they go out, they buy the property, not just me, me and a bunch of other people. We write a check and they go out and they buy the property, they manage it, they handle everything. Obviously, I'm not going to get like as good of a return if I'm doing it all on my own, but I don't have the
Yeah.
headache of doing it all on my own. I don't deal with any of the problems. I mean, unless there's like things like if there's a pause in distributions or capital calls, but for the most part, I just vet the operator, the sponsor, and write them a check if I like what they're doing. And it just makes it nice and simple. But I mean, even that, I had to talk to so many different sponsors and operators. I mean, I must have talked to 25 or 30 different people, interviewing them, asking about where they invest, why they invest, what their track record is. I mean, it was probably about a 6 month process of me trying to understand everything because it was like, even though I understood their asset class, they would underwrite these deals and I would have no idea if the underwriting looks correct. Like, do the numbers actually pencil out? Everyone says
Mm.
that they're conservative, but are these numbers actual conservative? So I went through and started underwriting all the deals myself. I must wrote 3 to 5 deals a day, just maybe spending an hour or two a day just trying to understand the metrics behind the math to know like just to feel confident because a lot of these deals, the minimum investment is 50K, maybe 25K, all the way up to 100K or more. I mean, that's a
Mhm.
good chunk of change. I want to make sure that if I'm handing someone 25K, that they know what they're doing, that I feel confident in their numbers. So it's just like this long process of talking to different operators, reviewing their deals, just learning as much as I could. Again, I was working with all these investors, but I had never done any of the math behind it. I'd never invested in real estate. I didn't know what was a good market, what was a bad market, that type of thing. What's a good asset class, what's not a good asset class. So it's just like just a massive undertaking on my end trying to understand all the different asset classes out there. I mean, multifamily was pretty easy. I mean, that was the easiest one to underwrite. But then it's like, okay,
Mhm.
now we're doing mobile. We want to invest in, let's say, mobile home parks or triple net lease. Like, how do those numbers compare to multifamily? So it's just it was a huge learning curve. It was just really forcing myself to like be uncomfortable out there, and
Yeah.
underwriting these deals and trying to learn as much as I could because I didn't want to go out and spend, 25, 30K through like a boot camp or anything like that. I just felt like that was like a lot of money to me. I just wanted to go out and do the self-education and then
Yeah.
eventually just made that first investment because of it.
Wow. So how long did that self-education take you?
Yeah, so that took me I probably started in I'm trying to think. It was the summer of, or the spring of 2022. And I was actually talking to a mentor that I met through a
Mhm.
LinkedIn group. And he was like, you have to make that first passive investment by the end of the year. And I was like,
Mm.
oh, that seems, that's, it was kind of terrifying because that was like one of the first conversations I had with someone. And then I just self-educated myself that entire summer into the fall. And I was like, okay, by January 2023, I want to get into that first deal. And I happened to come across a sponsor that I had talked to. She was actually one of the first people I'd ever talked to. I was on an email list for about 4 or 5 months, and they had a deal that was coming up. And what I liked about it was the triple net lease that I had mentioned, and they were
Yeah.
closing the deal at sometime in December. So I think I got into it in that November of 22 or October of 20, late October of 2022. And what I liked about it is at that time in the US, I could get 100% depreciation on it where now it's starting to go down every year, where I believe this year it's like 80%, and then next year it's like 60%. I forget the exact numbers, but it drops back down by 20% year over year. Not that I would invest in any deal just to get the tax benefit out of it, but I knew
Hmm.
I would get that nice extra 20% depreciation going from, staying at 100 versus 80 if I waited until 2023 to do it. And yeah,
Yeah.
but she was, I mean, honestly, like talking to her was asking her like what's the difference between an accredited investor versus a non-accredited investor. I mean, we're talking like very bare bones, like no idea of
Yeah.
what it is. And I actually met her through Bigger Pockets, so I was perusing that forum too and just contacting people on that platform to hop on a conversation and just talk to them. So that was another big, besides LinkedIn, that was another
Wow.
big networking tool just to find people and talk to them.
Yeah, I find that people in the real estate world or the real estate investing world, they're so good at helping.
Hmm.
Because when I'm in a lot of different groups and stuff, but I had to do a lot of research, a lot of asking questions, a lot of meetings, and everyone was just absolutely fantastic, just willing to actually help and want to see you succeed because you just never know when that can form into like a working relationship or a business relationship down the road. So I think it's really important to, have those connections and people that you can go to.
Oh yeah, I couldn't agree more with that.
Yeah. So you mentioned sponsors and operators. So just define both of those for us.
Yeah, most certainly. So I find I just use honestly just interchangeably between the
Okay.
sponsor and the operator. So a lot of the times the sponsor is the operator. Sometimes it's been interesting to me the more I learn about the real estate space. Sometimes you might have a sponsor where they're the capital raiser, where it can sometimes honestly it can be confusing sometimes where someone will come to you and they'll say, "Hey, I have this opportunity. Let's just say it's a 100-unit multifamily apartment complex," and they're actually the sponsor. They're not the one operating it. They're just raising capital for the operator, and then they're going to get a small percentage. They'll typically be on the GP team, and they might get a let's just say a 0.25% of whatever it is, or 1%, a very small percentage of the profit, but they're going out there and they're helping to raise the capital, and and that would typically be like your sponsor, and then they're
Hmm.
passing it over to the operator. But sometimes it can be confusing to me because you have the sponsor where they're not the one managing the property at all, but they're coming across as if they are managing the property, where all they're doing is raising the capital and then they're adding in their extra fees onto it. Where I try to find the person that's raising the capital and managing the deal itself. And I was reading about it the other day, and they put a name to it. I believe it was called feeder funds, is what they're talking about. I was reading the magazine, I believe it was called The Real Deal, and they were talking about how these sponsors they're going after doctors and lawyers, dentists, and promising that the financial freedom, and they're just raking in just millions of dollars of capital, but they're not the ones ever managing the deal. So in case something goes wrong, it's hard to get information out of the sponsor. So it's almost like there's like a layer in between. And that was something that I had to learn, to just because someone is offering a deal doesn't necessarily mean that they're the ones who's going to be running the deal. So you
Mm.
definitely have to do that extra due diligence. And I don't, personally for me, like if I'm investing with someone, I want to make sure that they're the ones that are running the deal, not that they just found the deal. And it's honestly, there's been a lot of people I've seen pop up recently where they're the ones going out there, they're vetting the sponsor, they're finding the deal, but then they come across as if it's like their own deal per se. I don't know. It's just
Hmm.
if I'm investing with you, I want to make sure you're the one operating it, not just that you're promoting it. So I find a lot of the sponsors are just promoting the deal, where the operator is the one that's actually going out there and, running the deal and managing the day-to-day operations.
Oh, okay. So like why is that your preference? Like, do you see any problems if it's just someone just kind of promoting the deal as opposed to running it?
Yeah, I find the biggest problem I've seen an issue with that is just the communication aspect of it. Is
Okay.
if something goes wrong with the deal, and let's just say the multifamily space, there's been, problems within the multifamily space over the last year or so, just given, especially in the US, given the interest rates, how quickly they've gone up, and so many people are using short-term bridge debt and on a variable
Yeah.
rate, and it was just, they got crushed because of it. Long
Yeah.
story short, with that, I find that there's just that communication aspect of it where now I'm relying, like, okay, it's almost like you look at it. if the deal goes bad, I want to know, like, am I at 100% loss of capital? If I put in 25K, am I getting anything out of it? Or is that money gone? And the problem I
Mm,
find is that I could reach out to the sponsor, then they have to reach out to the operator. So there's almost like that middleman in between where
mm.
I just want to be able to reach out to the operator themselves and not have that, not have that middle connection. And again, that's just
Okay.
my preference. I find that there's definitely a market for it. I mean, if you're very busy and you don't have all the time to go out and vet your deals, then you can put your money with these sponsors who then pass it over to the operator. But just from the communication standpoint, I find that from like the one sponsor that I've invested through, it's just they're like the communication's always delayed from them because they're the one that's having to send it out. It's not coming to us directly. And it's just, I don't know.
Mm,
I just like hearing directly from the sponsor, knowing it's from them. And then I know too, like, there's an extra fee added on for the person that's raising this capital for the operator because obviously they're not doing it out of the kindness of their heart. There's
yeah.
there's obviously going to be some money involved. They have to make something. They're not just again
Yeah.
they're not just doing it. So it's like there's already a decent amount of fees when it comes to investing in these deals. Like right off the bat, there's like an acquisition fee, which is typically like 3%. Then you have an asset management fee. Then
Yeah.
you have, yeah, I mean, it's well worth their money. I mean, they earned it, but then you add in like the sponsor fee on top of that, and then your fees start, and it's like, is it even worth investing in these deals?
Yeah. That's actually a really good point. Something I've never thought of. So yeah, thanks for bringing that up and pointing that out because that does make a lot of sense. Yeah, because of course you want to invest in a deal where your returns are going to be maximized, and if you have that middleman, then that's cutting into your returns.
Yep, exactly.
Yeah. Okay, so you talked about due diligence. What are some due diligence steps that people should take when they're investing in any project?
Well, certainly. So I find that, and I like to think of it like horse racing per se, where I'd rather bet on the jockey than bet on the horse. And what I mean by that is I want to make sure the quote unquote jockey, the operator, that they're going to be doing a good job in case something goes wrong with the deal. So you could think of the horse as the deal and the operator, the one putting together the deal. And for me, it's like I want to have that full confidence in the operator that they know what they're doing. So typically, I'll have a call with them, and right off the bat, if they show up late to the call, that's just not going to. I'm just not going to invest with them. And something simple like that. So that's first off the bat. They tell me I guess what I'm looking at is like, what are they telling me? So they tell me that their deal is very conservative, but then I'm going to be getting a 40% IRR, internal rate of return. I mean, to get like a 40% IRR, I mean, you're taking on a ton of risk in that deal. So
Okay.
it's like, how is this, a safe deal to invest in? Like with the triple net lease, I expect to get like maybe a 12% IRR when all said and done. Lower your IRR, the less risk the deal is going to be. So are they just telling me that? Like I've talked to a sponsor and they tell me they give out Christmas bonuses. Like, well, I'm not your employee. I mean, it sounds too good to be true. And I'll give you an example. And luckily I didn't invest in it, but there was an oil and gas deal and it offered a 200%. It was a it was a carbon recapture. I don't know, carbon recapture offering. I don't know exactly what that means, but long story short, it offered 200% depreciation. And like that just sounded too good to me. If you put 100K into the deal, you can write off 200K. So long story short, the deal ended up being a Ponzi scheme. And
Oh, wow.
I don't know of anyone that invested with it, but I was talking to different investors that were considering it. But when they were going through, like, all the books were off, the numbers didn't look right. So just different things like that. So like if it sounds too good to be true, there's so many sponsors and operators. I'm just gonna hold off investing.
Yeah.
There's another one that's gonna come down the road where I'm gonna talk to them. A big thing for me is typically you're talking to the investor relations person, you're not talking to the person that runs the company. So how's that person that I'm talking to? Do they seem like they know what they're talking about? I want to make sure that there's a well put together
Yeah.
team. So just those are like the easy basics that I walk through. And then after I hop off a call, I always send them an email and see
Mhm.
how long they take to get back to me. They take like 2 weeks to get back to me. Well, it's like I don't really want to invest in your deal because if you're taking 2 weeks to get back to me now and I haven't even invested any money with you, then that doesn't make me feel that doesn't really make me feel
Yeah.
comfortable. And then
Yeah.
if I'm really feeling good about what they have to say, and everything, then I will do a background check on them. And this one was interesting. And I always ask him, "Hey, I'm running a background check on you. Like anything that I should know of before I go out there and run this, and just give them an opportunity to tell me, anything that might come up." And this one gentleman didn't, he's like, "Oh no, everything's fine, clear." And it was like 5 years ago he had a bankruptcy. And I'm like,
Oh,
that's a pretty big that's a pretty big life event. I mean, that's like
yeah.
having a child, getting married. I mean, bankruptcy. I mean, that's like that's like a life altering event there
Yeah.
for a while. And he didn't even mention that to me. I was like, "Oh yeah, I'm sorry, I forgot." So I mean, like
I
that's like an example where
forgot.
I'm like, okay, like I don't want to invest with you. Where conversely, another gentleman, he said, and I asked him about it. He was like, "You're gonna notice some tax liens on there. I was going through a divorce. Me and my wife were caught in the middle of these properties and it ended up lapsing." So I went on and I saw that, and that one was perfectly fine. And I invested with them, and there's been no
Hmm.
problem since. But like, if he didn't tell me like that there's going to be showing tax liens on his property, because that tells me he's not paying his property taxes. And it's like, why would I invest with someone that can't pay their property taxes? Because eventually it'll just get taken over, by the state or the county and whatnot. So those are really the things I look for on the surface. And then after that, I'll probably usually just start reviewing their deals, take a look at like what market are they investing in? Is it a market that I want to invest in? Is it a cash flow deal where I can get 7 to 10% monthly? Or is it more of an equity play where maybe I get 4% cash flow, but in the end I'm going to be making more money, where that could be like a multifamily value add type of deal.
Hmm.
So I'll look at that. And then I'll talk to, usually once I'm like, I'll go through all this, I feel confident, I'm ready. I'll say, "Hey, can I speak to any of your previous investors?" And then just call them up. "Hey, how's the communication been? How's the distribution been? Would you invest again with this company?" And but I mean, usually at this point, once you've done all this due diligence, it's pretty easy to have that conversation with those investors and then ready to pull the trigger on the deal and invest that cash. So I mean, it's a it's funny because it's passive investing, but like it's very active to a certain degree.
Yeah.
'Cause I don't want to just blindly give my money to someone. I want to make sure I'm betting these deals because, like I mentioned, back in 2012, there's been where there could be so many syndicators and operators, and there's been really a massive rise of them in 2020. And there,
Yeah.
a lot of people are just, I feel like sometimes they're getting into it for the wrong reasons. They know, hey, if I go out and buy this multifamily apartment complex, I get a 3% acquisition fee at closing. They're going to make 100K on the deal, and I'm not. It just feels like there's a lot of them out there that I feel like are just in it to make those fees. So it's like, okay, who's
Mm.
going to be? But there's also a ton of good operators out there. But for when you're
Yeah.
someone like myself that's newer, you just have to talk to a lot of ton of. I just talk to a lot of different people, and I use like you mentioned or like I mentioned earlier, like Bigger Pockets. There's another
Yeah.
platform I use called Left Field Investors, where it's primarily made up of passive investors, just to get people secondhand knowledge on a sponsor, and
Mm.
I'll typically only invest with a sponsor if I have seen someone else talk about it somewhere, where whether that's on Bigger Pockets, whether that's on the Left Field Investors site, where I want to know someone else that's invested in this deal to make me feel comfortable,
Yeah.
about investing in it.
Oh, good for you. It sounds like you do a lot of due diligence, which is very much needed.
Yeah, yeah, most certainly.
Yeah, because a lot of people, like we're hearing a lot of stuff happening in the whole investment world now, and people are just losing money, investing in deals that, well, with people who have pretty good reputations. And I don't know what happened, but yeah,
Mhm.
it's really important to do your due diligence because, like some people they're investing their life savings, right? And
Mhm.
to lose all of that can be devastating. So good for you.
Thank you.
So have you ever made any mistakes, like, or any bad judgments in your investments?
I would say probably if I could go back, and one thing that I would do, and it's just my preferences. So I invested, it was me and it was three out of the four investments I've done. I've gone out and did them all on my own. And this one investment, it was a group of me and 10 other individuals. We invested in this deal, and we just wanted to get exposure to a different sponsor. So it was very small. We put in 5K each into the deal to get to the 50K minimum. But we invested through a platform called TribeVest, which it's a great
Okay.
platform, but the issue that we ran into, or I run into with that, is it costs about $350 a year for just like the TribeVest platform. Then it's about $150 a year for like the LLC to get that set up. So that's $500. And then it was
Wow.
$1,000 for the accountant to go through and do the K1 for the group. So we're talking $1,500 a year for it. And on this particular deal, we're getting 5% cash on cash right now. So my monthly distribution is about, I get $17 on the deal, but I only get it like 6 out of the 12 months of the year because there's just so many fees involved investing through this platform. So if I was to like co-invest with a group, especially through like a TribeVest platform, I wish I would have just put more money into the deal because it's like you don't get distributions half the year because they just go to fees. And then I only get $17 a month, which is it's not a whole lot. I mean, it's a good learning experience, but if I could go back, I'm like, I wish I would have just put more money into this deal where
Yeah.
it's just getting crushed with these fees. So if I was to co-invest ever with another group, especially through like the platform TribeVest, I would just put more money into it because
Yeah.
it's almost right now it's more of like a learning opportunity than anything else
Yeah.
with how small our distributions are that we get.
Well, $17, you can buy yourself lunch or something.
Yeah, exactly.
At least it's, positive cash flow and not negative.
Yeah, that's true.
Yeah. So if you could go back in time and visit your younger self, what piece of advice would you give him?
Yeah, I wish I would have just invested earlier and sooner. I mean, that's been the biggest regret I probably had when it came to this passive investing was just not investing soon enough. And for me, it was more of a numbers game where I'd always invested in the stock market. And
Yeah.
typically, on average, you're going to double your money about every 7 years in the stock market. And that was fine with me. But when I was investing in the stock market, you get your ebbs and flows. And not that I touched the money and I just put it into an index fund. So it's pretty reliable. But some years you might make 10%, some years you might go down 10%. But again, not touching the money. But historically speaking, you're going to double your money over 7 years. And looking at real estate, you can, depending on the type of deal, hopefully you could double your money in 5 years. So I'm not trying to double my money in 18 months or 2 years. I'm just trying to double my money in 5 years versus 7 years. And then you start to do the
Yeah.
numbers and you're like, well, that could shave off about 15 years. I could retire 15 years earlier investing in real estate than just investing through the stock market as long as you don't invest in a deal where you lose all your capital and different
Mm.
things like that, where it goes back to vetting the operator of the deal. I just wish I would have invested. I was so heavy aggressively investing in the stock market where I put like all my money there, where I'm like, I wish I would have taken more of that early on and put it into real estate. I like for myself, I like to have about a 50-50 split between investing in the stock market and investing in real estate. I know a lot of real estate investors knock on the stock market, but I'm like, at the same time, you could look at a 100-year chart, you're going to make about 8 to 10% on it, where real estate, hopefully you can make 12 to 14%, 15% on your deals. At
Hmm.
least that's what I'm looking for on my end. So I wish I would have just put more money into it and not has been so much stock market heavy, where right now I like the 50-50 split where I still invest in it, but then I also invest in real estate. So if I could go back in time, I would have just tried to put more money in real estate. I mean, if we're talking 2020, you probably could have doubled your money in 12 months or 18 months. It was
Yeah.
it was a crazy market. It's
Yeah.
it's not so much happening now. Now you're looking at about 5 to 7 years. But
Yeah.
if I could have done that in 2020, I would have, I mean, it was crazy. You hear a deal, someone puts in 50K and the values just rise so quickly and they walk away with 200K 2 years later.
Yeah.
It was crazy. It's
Yeah.
obviously that's probably not going to happen now, but I wish I would have just
No.
invested into real estate earlier.
Yeah. Why do you think you didn't?
I think it was more just I was almost like I don't know if it's scared or not having the confidence or just thinking like
Hmm.
for me I was like I don't want to deal with tenants. I'm too passive as a person. I feel like I couldn't
Yeah.
I feel like I couldn't kick them out. So I think there was that aspect of it. And then when you're talking the passive side, I always thought like, okay, if I want to go out and buy a multifamily apartment complex, let's make it simple. Let's say it's $1 million, and then I have a property management team that comes into it. I know I need like 200,000 in cash just to put the
Mm.
20% down, and we're talking, and it's still a pretty highly leveraged, not including capex reserves and different things like that. So I always thought it was like unattainable for how much money.
Yeah.
And then it was like that light bulb once I started like, oh, I could buy that $1 million apartment complex by putting in 25K, and I could get 10 other people to put 25K that, people I've never met before or don't even know, but between the 10 of us, we could put that money in, then we could go out and buy it and someone could manage it for us so we don't
Yeah.
have to handle it. So I think there was that aspect of it where I thought it was going to take a lot more money to get started than I initially thought, and then what it actually was to get started.
Yes, that's true. And that seems to be what a lot of people think because, well, a lot of people don't know the concept of, using other people's monies, doing JV partners, anything like that. There's so many different ways that you can get started, and you got to get really creative too. But it does help to have people that you can ask questions to and a community surrounding you. So that's very helpful. So, what are, excuse me, what are some of the common misconceptions about your type of investments?
Yeah, I would say probably the biggest misconception is that all the money is just going to be gone, that the people are just going
Yeah.
to take the money and run with it. I would find that another one is that it just takes a lot of money to make. It takes a lot of money to get started in the investment. I would say, looking at it, at least for my personal preference, that I wanted to go through and figure out like how how long would it take to achieve financial freedom investing in these
Hmm.
deals? And I went to, just bare bones. It took, when I was running through the numbers, it would take about 7 years for me to hit that financial freedom number. I mean, we're just talking bare bones expenses like utilities and mortgage and different things like that, but enough to get those expenses wiped off the table. And I think a misconception people have is that, and I see it a lot on LinkedIn, but they're talking about passive investing, financial freedom, get that passive income. And I'm like, it's going to take a while for me to do this. I mean, if I'm putting 25K into a deal and it's paying me $200 a month, I mean, that's great. But I mean, that's going to take quite a few deals for me to get to that passive
Yeah.
income number. So I think there's like that promise where it's like easy passive income where it's like, no, like you probably have to invest 1 million to probably 1.5 million into it, where
Wow.
for you to get that financial freedom number, I think they just make it seem easier. And then they also mentioned that it's passive, it's hands off. I'm like, there's a very active portion of it. And I know we talked about it before, but you have the due diligence, and it doesn't even include like going through, I believe it's the private placement memorandum, and that's like 50 to 60 pages long, and that goes over everything like what happens if the operator passes away, what happens if the deal is foreclosed on, what happens if there's a capital call, and you have to go through and read all that, because it's been scary where I've seen investors where there's a provision in there that there's a capital call and the operator needs more money. And if you don't invest in this capital call, and maybe it's 20% of your investment. So if you put in 25,000, now you have to put in another 5,000 into the deal. And if you're like, hey, I don't want to do that, I think this deal is done, then the provision is you lose 100% of your capital, which is pretty
Oh,
crazy. So I've seen operators put that into that PPM. So you have to go through and just do all that due diligence. Usually the majority of them would have some sort of where they would just liquidate your shares if you don't participate in a capital call, where instead of saying you invested 25,000, they would just knock it down to 20,000 because you didn't participate. But that's
yeah.
more comfortable, but there's definitely the ones that would dilute you all the way down to zero. And it's like
Oh
it's
my goodness.
very, so you have to do that due diligence. I mean, it's pretty dry sitting there and reading the 60-page document going over,
Yeah.
the event of everything. But you have to know it, because if, like I mentioned, if I'm like, hey, this operator who I thought was good, they're not very smart. I don't like what they're doing with their deal. I'm like, well, I don't want to invest that 5,000 more into their deal because I feel like I'm going to lose it. But if I don't, then I'm going to lose 25,000. So is it worth losing
Yeah.
25,000 or trying to put the extra 5,000? So I mean, it's like those are the situations you want to try to avoid as a
Yeah.
passive investor, and that's the very active side of it. So I think people have that misconception that, oh, let me just hand you my money, I'm gonna double, triple my money very easily. I'm like, there's been
Uh,
a ton of sponsors or operators, I should say, that have paused distributions, that they've had capital calls in the last year. I mean, even the ones that were good, that couldn't foresee what was coming. And I think people just think it's like they compare it to the stock market, where they're like, oh, the stock market's only going to go up or down. And I'm like, well, instead of, at the same time, like, if I have a capital call, if I have no distributions coming in, then that money probably would have been better off in the stock market. So I think there's that misconception
Yeah.
too, where people are, and I find, I don't know if it's more the operators, but they're like just bashing the stock market. I'm like, for me, I just invest in it's a total stock market index fund through Fidelity. And you can just, again, look at historical averages, about 8 to 10% on average a year. Not that it's, very linear, but at least the money's putting, something's happening with the money there, where I think like they make it out like you invest in these real estate deals, you're never going to lose money. And I'm like, well, sometimes you could lose money in the stock market, but I could also lose money in investment. I feel like there's people don't understand the risk where you could lose 100% of your capital in these real estate deals. For me, I find it way riskier investing in real estate than I do, and at least I'm not buying individual stocks. That's why I don't feel as though it's as risky. But I mean, it's
Yeah.
regulated to a certain degree, but it's also unregulated to
Yeah.
a certain degree where I don't feel like the SEC can have their fingertips on everything. Where when I'm investing through Fidelity, I have pretty good confidence that everything is well regulated on that side. Like I could go out and be like, okay, I could go get an attorney, put together some papers, start to raise capital on a deal if even though I have no idea what I'm doing, but I
Yeah.
hire a good salesperson to sell the deal per se. So it's definitely riskier. I find investing in real estate, just with these operators, at least that's what I've seen. But because of that, you're going to get a better return, which is why I like investing in real estate. I'd rather take on a little bit more risk and get more return
Yeah.
on my money to hopefully accelerate where I can, whether or not I want to retire, but at least have that option to retire
Yeah.
at some point if I want to.
Oh, that's excellent. That was like the real raw, dirty truth about real estate and investing. That's good because a lot of people talk about the glamour and you're right, like real estate, it's a long-term uh
Mhm.
goal. Like it's like the long game. You're not going to get rich quick overnight. And I think that's how a lot of people try to sell real estate. But as I, learn more, I realize it's like, yeah, it's man, I'm gonna have I'm gonna have to have this many properties to make this much money, and it's gonna take this amount of time. And then there's all the due diligence that you have to do, which takes time. So if you're looking to get into real estate to, make a quick buck, it's the wrong business to be in because it's more of a long game for
Yeah,
sure.
exactly.
Yeah. Well, thank you so much. Let's go on to the lightning round. So this is where I'm just going to ask a couple of fun questions about you.
Perfect.
Okay. Excellent. So if you could have dinner with any historical figure, who would it be and why?
So if I had to say a historical figure, I don't know if you would call, I'm thinking of like history because my dad's a history teacher, but I would probably have to
Oh,
say Steve Jobs. And just,
oh,
I find
nice.
that, yeah, just fascinating, just his story of Apple and how it changed the world. And that was like, this is a book, Steve Jobs by Walter Isaacson, and it was like 600 pages. And it was like the first really long book that I ever read in my life. And I just found his story to be very inspirational and what Apple did to change the world. And as you can see, since he passed away, it's probably been like 10 years now. But you can see now, like,
Yeah.
there has been a lot of innovation and change at Apple, where when he was the one running it, there was introducing the iPod and then obviously the iPhone. And what he was able to change in the world is obviously, you know, it was pretty spectacular. So I feel like having that conversation with him on how he did it and ran the company would be pretty fascinating.
Yeah, you're right. I agree. He was a very great and powerful leader.
Hmm.
Although a lot of people said he wasn't very nice, but still,
Yep.
he got the job done, right?
Exactly.
If you were stranded on a deserted island and could only bring one item, what would it be and why?
Ooh, that's a good one. I would I would probably say that's a good one. I'd probably say a book, to be honest. I find that
Yeah,
just to pass the time, I feel like the common sense would probably be like water or food, but for me, just
yeah,
if I'm stranded, might as well just write a book and just trying to pass the time so I don't go insane out there. And I love reading books. I try to read at least one every 2 to 3 weeks. I'm always trying to learn as much as I can. And I feel like maybe bring that Steve Jobs book and that would help pass the time quite a bit.
yeah. Okay. I guess you're a reader. Do you like mostly read or like listen?
Mostly read.
Oh, good for you. I
Yep.
used to read a lot, like an actual book. I used to like to hold the book but now it's just life is so busy. I just one audio book after another. But at
Yep.
least, I listen to them and I learn a lot. So if you were given the chance to start a dream project today with unlimited resources, what would it be?
Ooh, that's a good one. I feel like for me, it would probably just be starting some sort of shelter for dogs. And I just
Aw.
just love dogs. I feel like that would just be like it's almost like something I look at like retirement, just like having all these shelter dogs, just having like 15 or 20 at a time on the property, just taking care of them, and then obviously, giving them out to families and adopting them. I feel like that would just be such a fun project where, having all the money in the world to just build a very nice spot for them, and then also being able to have all the time to help manage them because that would not be that might not have the time right now. But yeah, I think for me, just like helping all the dogs that are out there. I mean, I just love animals, so I feel and I've honestly I've thought about that before. I was like, I was like that'd be pretty cool if I was like retired and maybe I didn't have like 20, but I have like 5 or 6 at a time that I just
Hmm.
help out, and then we adopt them off as they get back to full health. I feel like that's something that would be pretty fun to do.
Aw, and that would be very rewarding too.
Yeah,
Good.
exactly.
And where can people find you?
Yeah, most certainly. So they can check out our company's website. That's just podcastingyou.com. That's podcastingyou.com. Or they can just connect with me on LinkedIn. That's just going to be my name, Trevor Oldham, and happy to connect there and have a conversation there as well.
Excellent. And I'll include those links in the show notes. All right. Well, thank you so much for joining us today, Trevor. It was a great conversation.
Thank you.
And thanks to everyone for watching and listening. And we'll see you next time on another episode of Newly Invested. Happy investing. Bye.
And that brings us to the end of another enlightening episode of Newly Invested. A huge thank you to our guest and to all of you for tuning in. Remember that investing in real estate is a journey filled with highs and lows, but the key is to keep learning, keep investing, and keep growing. If you want to stay updated with our latest episodes, don't forget to like and subscribe. And if you enjoyed today's episode, we'd appreciate it if you could leave us a review. This is your host, Judith Tait, signing off. And we'll see you next time on another episode of Newly Invested. Happy investing! The views and opinions expressed are those of the host and guests and do not necessarily reflect the official policy or position of the podcast. The information shared in the podcast is for general informational purposes only and should not be considered legal, financial, or professional advice.